So now this is the run phase of the business of the wholesale model. And in the walk phase, we were talking about buying 1,000 shares of Facebook, and I was explaining the difference between the bid and the ask and the different key players that are in the market and their objectives and all that. So this is the part where I'm going to explain it to you so you can get proficient at it, right? And then obviously nothing beats chart time, right? So you're going to have to see this play out over and over on the chart, no matter how many times you watch this video. So let's say that you're up early and the market is open, right? The news says that the market is going up today. Facebook is all over the news because of whatever headline they decided to produce that day, right? Everyone is saying it's going higher in the morning. So you decide to buy that 1,000 shares of Facebook, right? And since you are new, you're really not sure of the price. So you decide to buy it when the market opens, right? And when the market opens, the price of Facebook gaps, right? Moving up and really is pushing higher and higher and higher, right? So you go to buy some, don't get in any at the price you wanted. So if the first half hour of trade starts, the price just seems to keep going higher and higher and higher, right? And you keep moving your order up, but you still don't get in, right? So you just hit the buy market button, right? Order fill. Let's say the stock has opened at 167 and gaps up to 170 and keeps going. Your order finally gets filled at 171. Perfect, you think, right? Now, just wait and sell higher, right? Whoa. What's going on? The price is going down now. It's at 170, then 169, then 168. Man, you're already down $3,000. You try to sell, but the price just keeps moving lower and lower and lower. You're freaking out. So you click the sell market button. You get filled at 166, you lost $5,000. What just happened? So let's talk about what actually happened here. So the market makers, let's call them Tuna and Bobo, both work at two different firms and trade Facebook. They are drinking buddies and they split a house in the Hamptons in August and act like crazy teenagers at night, out with their dad's black car. So Tuna and Bobo both see this huge demand coming in the morning. They don't have enough Facebook orders in their inventory to fill all the orders that they see on the order flow. But here's the thing, they have to fill these orders. These guys know there are hundreds of other firms willing to fill these orders. It's a huge source of income, so they will not say, no, I don't have any comeback to the brokerage firms that they work for. So what's a poor degenerate to do? Okay, we will short the stocks to them. Now remember, shorting is selling something you don't own. The way to make money is to buy it back cheaper. Now there's not many places you can get away with that. You try to sell anything and buy it back cheaper, they'd throw you in jail. So we got these two knuckleheads, and they are going to sell shorts to retail, but they don't want to sell short at 170 and buy it back at 175. You don't stay in business this way very long. So what do? They bid the market up before the market opens. When you're a market maker, you can move the market up in the morning without having to buy too much stock. So these two will now move the price of the stock up without buying or selling much at all. And that's the secret. Once the market opens for trading, they will have to take the stock up as much as they can. Maybe from 170. Remember, it closed yesterday at 167. So that's a $3 gap that they had to move it during pre-market. As the orders come in, they will keep taking the market higher, using all the rules of the market making and dirty tricks they have. They will show really huge bids to make people think the stock is going higher and increase the price they want to buy it at. This plays on our emotions. Meanwhile, as they take the market up, the waves of buying will either get stronger or subside. Most of the time they subside, and now is when it gets really interesting. Once they look at the order flow and see that these other players aren't placing buy orders like they were, this is what they do. Once they have taken the stock to, let's say, 172, they will have an average of what they sold at. The average, we'll say, is 169. Now they have to do is what Now what they have to do is what is called a rug pull, right? And this happens when they see buying orders have slowed down and there's nothing behind them. Remember the waves that we talked about in the walk phase, right? So no big funds out there are sending any more big follow-up orders for big amounts of stocks, right? So they drop their bid and start selling, hitting the market down. As they do this, they will show huge offers, hundreds of thousands of shares. The retail day trader who uses the convenient level 2 data software will see this and immediately start selling. As everyone sells, Bobo and Tuna will beat them to the bid and wipe out any chances they have of selling at decent prices. Now these two will start to really go to work. If they see any buy orders coming, they will fill them so fast, then push the price down even farther. And all this drama creates a panic. They want you to panic and start dumping what you bought. And as you do, they will see and they will use your sell orders to push the market down even more. Once they see that the selling orders have slowed down, they will beat up the stock some more. This will cause some more panic, right? They will work off of each other. Other one sells, the other will buy, and then they will reverse this. So one's buying and one's selling off of each other, right? And no one who is not a professional trader will understand these techniques, right? So once they see size coming in to fill these shorts, buy back what they sold, they will go flat, completely flat. They won't be long and they won't be short. Now, this usually will take. Okay, and this happens all of the time, right? So right here, we're going to take and look at it on a TPO chart and what it looks like on the candlestick chart down here in the left. All right, so this is the business model of wholesale on a 30-minute market profile chart. Okay, and what you're going to see is that it's a rinse and repeat kind of system. It happens over and over and over again, and people just don't understand like why it can be this easy. It took me forever to like understand it until I saw it over and over and over again on the chart, right? And it basically goes like this, right? So wholesale will find a buyer to sell their inventory to between, in this case, 4193.5 and 4192.5, right? So in this area, these two yellow and white eyes, that's it. And then on the candlestick chart, that would be right here, this first green candle, right? And then, so this whole time, retail is thinking that it's going to be a huge retracement because H was a huge rally, right? However, it comes up, it goes down, right? And right here, this is a level of some sort that it responded to, right? Or it's just the area where a buyer steps in, right? A size buyer, right? So they place a huge order, right? Wholesale does what it does. They start selling this size buyer their orders, right? All right, let's move on to step 2. Size buyers see that there is no supply. So this is one buyer, right, who started bringing the market back up, right? His friends, the other size buyers, see that there is no supply in the market and start buying orders from the wholesale too, right? Bringing the market up, bringing the market up. And while they're getting into position, what's going to happen is this this buyer right here probably took the market from 4193.5 to, let's say for teaching purposes, 4194, right? Letting his buddies, the other size buyers, know that there's no more supply left in the market. Like, there was no strong selling right here, so they start buying in this area. And basically what's going to happen is it'll bounce back and forth, back and forth, back and forth, while these size buyers buy the wholesale orders, right? He's bringing it up, and then let's say right around here, wholesale starts running out of inventory, and because they started after this rally, like, they got too thin, so we had to bring the market down. There wasn't enough supply in the market to bring it down any further than this level, and a buyer steps in and buys, and then other buyers step in and buy. Well, wholesale ran out of inventory, and now what they have to do, the market's stretched thin, and people are still trying to place buy orders, right? Whether they're chasing price or if it's size buyers, whatever the case, right? So now wholesale doesn't have the inventory, but remember I said they can't afford to like lose these orders, right? Or another firm's going to grab it. All right, so wholesale sees these buyers still placing orders, so they short the retail. They start selling what they don't own, bringing the market up, stretching it thinner and thinner, right? And then the order flow of buying orders starts to subside, right? And wholesale has to make their money back on the orders that they sold but didn't own, right? So let's say right here at 41.97, right? 41.97, that's where they had to start shorting the retail, selling people who wanted to buy off of orders that they didn't own, right? Because they ran out of orders, right? And then they stretched the market this high up, right? Because the order flow continued to show buy orders coming in. However, that order flow slowed down, so now they have to make the money up from 41.97 to 4,200, right? So what do? Just like we explained before, they do a rug pull. So they drop their bid, right? And start hitting the sell button like crazy, right? And in doing so, the people with level 2 data will see this and, start trying to jump ship, right? So let's start with step 1, right? Doing the rug pull, right? Wholesale will start selling and forcing the price down fast and violently, showing thousands of sell orders, causing a panic, and everybody who bought on the way up will try and jump ship from their positions, right? And as retail and size buyers try and sell the positions that are losing price, wholesale buys it up from them and puts it back into their inventory, right? And those who bought who didn't sell their positions are now trapped. All right. And on the way up, when the buyers bought from the wholesale, right, they put their stop losses in places, and most retail traders put their stop losses under lows, right? So the buyers who put their stop losses under these lows, the I, the J, and the K, are now taken out of the positions for a loss, right? And then size shorts start getting into positions, creating supply in the market, right? And as they start placing these orders, like wholesale sees the order flow and beats the market down lower and lower and lower, because if somebody's going to place long orders going up or short orders, like, they're going to do what the wholesale's job is and provide that liquidity, right? And then once the short order flow starts slowing down, wholesale is going to rip it up, trapping the shorts. And then once wholesale goes flat, wholesale will go flat when they're profitable on both movements. And then they rinse and repeat. So you have to stare at the charts, whether you use a TPO market profile chart or a candlestick. Like, This is what's happening over and over again. Hopefully, this clarified a lot of stuff for you guys. Um, there'll be more classes to come to break down like what structure is and different things like that. Hey, thanks a lot, and later.